We haven't really hit the distress stage of the market yet. I think that's coming. Everybody's sort of anticipating it, just waiting for that other shoe to drop. So multifamily just got to the point where I just felt like, A, I couldn't really compete with people willing to overpay, but B, I'm by nature a value guy, so I just wasn't seeing the value. Everything was overpriced. If you're out there like holding property off the market or making investment decisions on the basis that you think that rates are going to come down, it's not going to happen for you. I think rates are going to stay. We're still in the situation where the sellers have yesterday's prices on their mind, the buyers are looking to the future, and the math doesn't work out in a way that both parties can come to an agreement.
Yeah. Do you have any thoughts on where these rates will be? Do you have any like base cases that you factor into in weighing whether to make investments or not? Do you think it's going to stay high for a while? Do you think it's coming down? Transaction volume's down too, and I think that isn't that part of the problem? Is like you've got so little transaction, it's almost like the price discovery is tough to do. It's hard to find out the cap rate because with so little transaction, like you said, sellers think their property's worth 2021 prices, and buyers are like, wait a minute, there's you look at the debt. On the proverbial baseball scale from first inning to ninth inning, do you have an idea or any thoughts of where you think we are in the cycle and what people should be thinking about?
Yeah, I mean, if you're going to use the baseball analogy, right, for a 9-inning game for the whole cycle, I think we're just...
Jonathan Twombly, thanks for joining us, man.
Absolutely. Good
We're here in your neck of the woods in Manhattan.
That's right.
Now you live. Are you in Manhattan? Or
I'm in Brooklyn.
Brooklyn. That's right.
Yeah.
So we're here at the MFIN conference in New York. Pretty good event. You just got off stage, so I'm glad we caught you. But you're in multifamily a lot. You do a lot of hotels as well, right? You do kind of anything that any real estate. What do you focus on?
Well, the focus recently has definitely shifted from multifamily to hotels. Just really opportunistic, but that's kind of where I'm focused at the moment.
Yeah, and is that just because that's where the opportunity is today versus a little frothy over there in multifamily?
Yeah, so multifamily just got to the point where I just felt like I couldn't really compete with people willing to overpay, but B, I'm by nature a value guy, so I just wasn't seeing the value. Everything was overpriced. I sort of fell into the hotel space because an opportunity came up to buy an asset that I knew that was just really attractively located. And as a result of that experience, I realized that there was a much bigger opportunity here.
So where do you think we are in general then on the real estate sort of, I don't know, there's no such thing as a real estate market, but in terms of, let's talk about multifamily. So you obviously know multifamily. Where do you think we are? We've obviously taken a little bit of a hit from the peak. I think we're probably down, depending on the marketplace you're in, maybe 20, 25, sometimes 30%. On the proverbial baseball scale from first inning to ninth inning, do you have an idea or any thoughts of where you think we are in the cycle and what people should be thinking about?
Yeah, I mean, if you're going to use the baseball analogy, right, for a 9-inning game for the whole cycle, I think we're just, first inning.
Wow, okay.
Yeah, I think we're really, really early in this. We haven't really hit the distress stage of the market yet. I think that's coming. Everybody's sort of anticipating it, just waiting for that other shoe to drop, but it still really hasn't.
And you think is that primarily due to the bridge loan products that are out there? Is that the main reason, or do you think it's a recession? What do you think is going to lead to the other shoe to drop?
Yeah, well, I think the change in the debt market is a big piece of it. Obviously, on the one hand, you've got all those people whose debt is now reset, that pushing them into distress, and on the other hand, there's like nothing to take it out. Right? It's hard to finance deals at the moment.
Right.
And with interest rates the way they are, we're still in the situation where the sellers have yesterday's prices on their mind, the buyers are looking to the future, and the math doesn't work out in a way that both parties can come to an agreement at the moment. I mean, there hasn't been that kind of wake up call yet for sellers, and I think people who are right now who don't have to sell are just keeping property back in the hopes that something is going to happen before they have to sell. But at some point their hand will be forced at some point, right?
Because transaction volume's down too, and I think isn't that part of the problem? Is like you've got so little transaction, it's almost like the price discovery is tough to do. It's hard to find out the cap rate because with so little transaction, like you said, sellers think their property's worth 2021 prices, and buyers are like, wait a minute, there's you look at the debt.
Yeah, I mean, this is a big problem, and I think also with the debt, I think we've been in a situation where nobody has known where debt was going, where like when the rate hikes were going to stop. So it made it very hard to underwrite deals because what's your exit, right? And I think once the Fed stops raising, which I think we're probably getting to the end of it now, I think you'll see stuff start to loosen up a little bit, because at least now people have some certainty about where interest rates are, what your exit cap rate is going to be, that sort of thing. That doesn't mean that buyers and sellers are going to be having a meeting of the minds yet, but I think at least on the buyer side, there's a little bit more willingness to take a risk when you kind of can, see what the lay of the land is.
Do you have any thoughts on where these rates will be? Do you have any like base cases that you factor into in weighing whether to make investments or not? Do you think it's going to stay high for a while? Do you think it's coming down? Do you think it's going to continue to go? It's like you already said you don't think it's going to continue up too much. But.
Yeah, I mean, so this is just my personal view of things, but and I don't have any data to back this up. My working theory has been that the Fed has actually wanted to raise rates for some time, back to some kind of normal level. I think they recognized that rates were too low for too long. They tried to start raising rates back in 2018.
Right.
Stock market had a conniption. Mm-hmm. They lost their nerve. They backed down, right? And then they had to lower rates dramatically because of COVID. I think inflation has given them the cover that they needed to raise rates back up to more of what I think is more of a normal and healthy level. So I think that if you're out there like holding property off the market or making investment decisions on the basis that you think that rates are going to come down, I think it's not going to happen for you. I think rates are going to stay where they are or slightly higher. I don't think they're going to get dramatically higher than they are now, but I think we're reaching the end of the kind of raising cycle. But I think that they're going to stay where they are, and I think that absent a real major financial crisis, they're going to stay there. So if there is a recession, I think what you'll see is the Fed giving some lip service, maybe quarter point cut, half point cut, but we're not going down to the interest rates that we saw unless we have a major calamity.
Yeah, and that's interesting because there are a lot of operators who do believe that interest rates are going to go down, right? And I'm with you. I don't think if it was up to the Fed, they would keep them where they are or do whatever they want to do. My theory is, though, that at some point something's going to break, and then they're going to do what they're supposed to do, which is they're lenders of last resort. They should bring down the things. But I think people just assume, well, interest rates are going to go down, things are going to be great. But if interest rates are coming down because something calamitous happened and unemployment's at 8% or something, and there's a major issue, that's probably not the good time. It's not the right reasons why you're going to be getting in. It's not the right reasons why the interest rate came down.
Right. That's a whole other problem that you've got. Right. It's not just interest rates. I mean, we've had this really kind of unique market for the last few years where you had super low interest rates. You had, like on an operating basis, apartments doing really well, right? Demand was super high. You could raise rents almost at will. And so that confluence of events, made it really attractive. The problem is that was kind of like a perfect storm.
Right.
And now you've got, other headwinds too. It's not just the interest rates, but you've got expenses really, ballooning, especially depending on what state you're in. Insurance, property taxes, labor is way up. So NOI is also taking a hit in addition to interest rates going up. So I think that it's going to, I don't know, I mean, I don't want to say it's going to get ugly, but I think it has the potential to get ugly.
What I love about what you do too is I always think of you a little bit as even though you focus on multifamily, almost like asset agnostic, because now you've seen sort of another opportunity, right? You're in the hotel space and you feel that's where some opportunities today, maybe tomorrow it's something else. Tell us a little bit why, what's the hotel, why hotels for you at this point over multifamily, for example?
Yeah, so as I started out saying earlier, like the multifamily, the value just hasn't been there as far as I'm concerned. Now, obviously, there's always like one-off deals and stuff, but I don't really feel that confident in my ability to ferret out that one deal, somewhere that really works. What I've noticed on the hotel side, though, and this is what we're talking about is very specific. It's independent hotels, so they're not non-branded, right? They're not part of a chain. They're usually mom and pop owned, right? And so they're
mismanaged.
So mismanaged is you got to kind of define what that means, right? A lot of these people have owned these hotels for decades, right? And now they are in their 70s, sometimes 80s, and they're just looking to retire. And this is running a hotel is a full-time job, and I think you've got this generation of people who are just ready to let go, and their children don't want them. Oftentimes they require a lot of CapEx because the way that these hotels are run is usually kind of on a shoestring. So they're not really reinvesting. It's gotten harder and harder for people in that situation to get loans from banks because banks aren't really lending to small business as much as they used to, and with bank consolidation, you're seeing a lot less availability of debt. So they don't really have the ability to like recapitalize their hotels, invest in them. Right. And then the other thing that we've found is that these mom and pop operators, they're old enough that they don't use technology. Right. So, and frankly, even if they're like, you're around the same age as me, like even if they're our age, they're not using technology if they grew up in the hotel business, right? So you see situations where, for instance, you can't make an automated reservation at these hotels. You got to go back and forth with them by email or by phone. They're leaving a tremendous amount of money on the table. So the assets are really underperforming. At the same time, because they require a lot of CapEx, there's the buyer pool is very limited for these hotels, right? So I can take my multifamily expertise as a syndicator. I know how to raise money for these deals. I know how to structure deals with investors. I have an operating partner who's really excellent at the rehab and the operations of the business, and together we can take these these old sort of tired hotel assets and turn them into something really nice and with a unique sort of position in the marketplace as well. Because the other thing too that we're finding is oftentimes where we find these hotels, if they're well located, there's a bunch of like sort of cookie cutter chain hotels, and then there's a bunch of like kind of crappy, tired old motels, and there's no alternative to those two things. So we can position ourselves in the market as being like the alternative for the people who want a unique experience, and sort of pitch at the middle of the market as opposed to the top or the bottom.
That's great. It sounds a little bit like I'm a little bit more involved in the mobile home park space, and it sounds like a lot of those same factors in that, with legacy owners, people who just they're on a shoestring. A lot of people don't really want it. The kids don't want it. Very fragmented. So it sounds like, although it sounds like in mobile home park, I think a lot of people can get in. It sounds like hotel, you need a little bit more specific expertise to run that. But same thing, technology, like mobile home parks, people are literally picking up rent in Post-it notes.
Yeah, exactly. Yeah. I mean, what it reminds me of really is multifamily when I first got into the business. So when I first started out in 2011, and I was buying deals in like Louisiana or South Carolina or whatever, the people that we were buying from were essentially the sort of same demographic. It was like the mom and pop who, they ran it well enough to support their lifestyle, but they didn't maximize the asset. And then, we had this massive wave of syndicators come in, and now, the prices are driven up. But also a lot of those people, syndicators get a bad rap. There are good ones and bad ones. I think as a general proposition, most of them are probably more professional than the mom and pops that they were buying for. So they have done value add. They have injected capital into them. So I think that opportunity, that mom and pop opportunity is largely gone, at least in the Sun Belt. But I think in probably a lot of markets, that opportunity is over.
Yeah. So last question, because I know you got to go, but do you invest passively as well, or are you in other syndications?
I co-GP with other deals.
One of the things I've been kind of fascinating, just because it's a big topic these days, which is cash calls, right? So, people ask me from a LP standpoint, what are the things I should look for if a sponsor comes to me and asks for more capital because their deal, they need the capital. What criteria would you think, or would you be suggesting an LP look at prior to committing a fresh, layer of capital, whether it's 5, 10, 15 grand or whatever it is? What should they be looking at? Because that's the question that comes out a lot to me, and so I'm trying to get everybody's opinion on that.
Yeah, I would say that they need to look at the asset on an operating basis, right? If the problem is, and the reason for the capital call is because interest rates have spiked, and you need more cash to cover, buying a rate cap, or maybe even a cash-in refi. If the property is operating well, right, occupancy is high, they're properly growing their rents, they're managing their expenses, as they should be. If the property is operating okay on an operating basis, then you're just essentially providing cash to get through what's going on now until either you have enough NOI growth that you can refinance your debt or what have you. But if the problem is that the property is losing money on an operating basis, then that's not the situation to be putting more capital into.
Yeah, that's good. And I always remind people that, unlike when they're originally investing, there's no PPM. It's not a new securities offer, so there's no attorney there to help you with the risk. And so it's really important for them to look at the business plan and, to your point, the operating. Like, what's the plan from this point forward, in addition to the thing. So anyway, John, I know you got to go. Really appreciate your time. It was always good to see you, my friend.
Great seeing you, Mauricio.
All right, take care. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.